China is doing something it has resisted for decades. It is opening its stock market to foreign companies. Beijing has announced that qualified foreign firms will now be allowed to seek listings on Chinese stock exchanges. On the surface, that sounds like a technical market reform, but the timing tells a much bigger story. Because this is not just about stock markets. It is about China trying to make itself more attractive to global investors at a time when foreign investment into the country is slowing. So what exactly is changing? Under the new framework, qualified foreign companies will be allowed to seek listings on mainland Chinese exchanges. China has also said it will encourage foreign investors to participate more actively in financial markets, including government bond futures. That may sound technical, but it marks an important shift. For decades, foreign investors gradually gained access to Chinese markets. But foreign companies themselves had very limited opportunities to raise money from Chinese investors. That is what Beijing is now trying to change. By opening the door to foreign listings, China is giving overseas companies access to one of the world's largest pools of domestic capital. At the same time, it is giving Chinese investors access to more international businesses. The message is clear. China still wants global capital. So why now? Because the investment environment has changed. Foreign direct investment into China fell 9.5% in 2025. It declined by another 5.7% in the first 2 months of 2026. Meanwhile, multinational companies have been diversifying supply chains under the China Plus One strategy. And tensions between China and the United States have made some global investors more cautious. In short, China is facing a challenge it hasn't had to confront for decades. It is having to compete harder for international capital. And that is a significant shift, because for much of the modern era, foreign companies wanted access to China far more than China needed them. Historically, China's stock markets were designed to raise money for domestic companies, especially state-owned enterprises. Foreign investors could access parts of the market through programs such as QFII and Stock Connect. But foreign companies themselves were largely kept out of mainland listings. Instead, many of China's biggest private firms chose to raise money overseas. Alibaba, Baidu and JD.com all listed in New York or Hong Kong, where capital was deeper and valuations were often higher. By March 2025, there were 286 Chinese companies listed in the United States with a combined market capitalization of roughly 1.1 trillion. Now, Beijing appears to be changing its approach, not just to attract foreign companies, but to deepen its capital markets, increase global participation and strengthen China's position in international finance. Bringing foreign companies to mainland exchanges could attract fresh capital, broaden investment choices for Chinese investors and support Beijing's long-term goal of expanding the global role of the yuan. But there's a catch. Opening the door is one thing. Convincing companies to walk through it is another. Capital controls remain in place, regulatory uncertainty has not disappeared, and geopolitical tensions continue to influence investment decisions. As a result, the number of foreign companies that actually choose to list in China may remain limited. That is why the significance of this move goes beyond the number of future listings. For decades, China controlled access to its markets because it could afford to. Today, slowing investment and a changing global economy are forcing Beijing to send a different message. China is still open for business. Follow Business Standard for more such stories.